One of the great traders and researchers for the past 2 decades is Larry Connors. I consider him my mentor even though he doesn't know my name. But he is really, really good, and he is, of course, the one who pioneered RSI2, which, of course, you know how much I love that strategy. Back in 2009, after the 2008 crisis, he published a book about trading ETFs, and one of those strategies is called the R3. Now, I love these books because we already have more than a decade of out of sample. So it is really an enjoyment for me to code these strategies and see how they perform for the past decade. The strategy is extremely simple, and here are the rules. Rule number one is that the close has to be above the 200-day moving average. The 200-day moving average works very well with the RSI2. The second rule is the RSI2 has to be below 10 today, because we are looking for a pullback. It's a mean reversion strategy. So we are looking for an extreme pullback. So below 10, that is extreme. Rule number three, the RSI2 3 bars ago has to be below 60, because we don't want a pullback from, let's say, RSI below 15, and then it goes below 12, and then below 10. That means we are doing nothing at the bottom. And finally, rule number four, the RSI2 has to drop 3 bars in a row. And that is it. That means we are looking for a powerful pullback that's happening 3 days in a row. So usually this is some kind of panic or huge selling, and then you want to pick up that instrument and go long. Our exit will also use the RSI, so we will exit when the RSI2 above 75. Now, the book didn't mention anything about a stop loss, and of course, if you leave this without stop loss, sometimes the RSI will, at some point it will go above 75, but you will face maybe, I don't know, 90% drawdown. So of course, that doesn't work practically. So I use the close below the average of 50 bars. Anywhere between 30 and 50 will work as a stop loss. Of course, you can add a dollar figure, an ATR, but since I'm implementing this on a portfolio of ETFs, I thought the moving average will work the best. So here is the strategy applied to the S&P 500. And if we pull the stats, the strategy made $28,000 with maximum drawdown of about 8,000. So we are making 4-to-1 return to drawdown ratio. Now remember, this is shares, and that's why you might find the number is low. Also, we don't have a lot of trades, only 72 trades, 54% win rate, and we are making about $400 on average. And here is the fun part. Remember, this strategy was published here, 2009. So 2010 and above, these are all out of sample. Nothing changed. This is exactly the rules from the book. And here's the equity curve. We have a drawdown here. So remember, this is the out of sample. So anything above here is the out of sample. And we can see the curve is beautifully moving up, with the drawdown is lower and lower. That is amazing to me, that a strategy published in 2009, we had 2015 crash, we had the COVID crisis, and the strategy performs beautifully on the S&P 500 as it was designed in 2009. Now, of course, as algo traders, we can expand this research and optimize any value we like. But I didn't want to go that route. I only want more trades. So more trades means less restrictions. And since we cannot play with the RSI2, I mean, the RSI2 is fixed at 2. I don't want to do 3 and 4 and 5 and so on. So the only way to get more trades in, I need to decrease the amount of RSI below the previous RSI. So instead of looking for 3 RSI down in a row, I'm going to look for 2 RSI down in a row. And not only that, I'm going to expand the number of look back to 5 instead of 3. So now this should let more trades in. Also asking for the RSI to be below 63 bars ago. I removed that. So that also should add more trades in. Okay, so going back to the strategy. So let's compile our new restrictions. So enhance our net profit. And if we look at number of trades, now we have 225 trades, making 290 on average. And let's look at our equity curve. Our equity curve is not as smooth as before, but still it looks very, very nice. And if I want to go to the periodical analysis, Now we have more losses here, but overall we are making more money. Now that's not necessarily a better equity curve or better periodical returns, but I'm only looking to increase the number of trades. That was my primary target, and that we did while getting more money, so I am happy with the results. This is an important concept to keep in mind because filters or enhancement doesn't have to be always the net profit. You might be looking, as in this case, only to increase the number of trades. And if we increase the number of trades while keeping the strategy intact, then that's done. That's the target of this filter, whatever we are doing. Sometimes the filter is only to reduce drawdown, sometimes to increase the average trade. And of course, if it does all of them, then all the better. So now we will apply the same strategy to a portfolio of ETFs. I have 25 ETFs here. They represent countries, sectors, and of course indexes, commodities, bonds, and so on and so forth. I'm testing the strategy since 2006, and remember the strategy was published in 2009, and we just relaxed the rules to get more trades in. And this is the result we get. We have more than 4,000 trades, so that's really good. That increases our confidence. Percent profitable is about 50, and on average we're making $172 per trade. So if we go to the equity curve, there's a huge drop here, and let's look at that period. So this is between 2018 all the way to May 2021. Annual period analysis, we did a really bad year in 2022, but now we are getting back. We already did 20,000, so that's almost 25% back in the first 6 months. Remember the strategy published in 2009, so all this is out of sample. And if we go to breakdown, we can see most of these ETFs are making money. All of them are doing very well in number of trades, except this one, LABU. This is, I think, biotech ETFs. It's only 53 trades, and of course it's losing money. XLB, that's a sector, and it's also losing money. This is a form of gold, losing money. But interestingly, gold ETF is making money. The best performer is XBI. It's $500 on average, very good equity curve. And XBI is the biotech ETF. And remember the LABU, it's also biotech, but this is a leverage ETF. I think it's 2 or 3x. So this is, of course, not leveraged, the XBI, and this is, and that shows you that, you know, leveraged ETFs not necessarily good even when the strategy is profitable. If you're interested in this strategy, the code will be available in the community. You can download it for free. And if you want to replicate it yourself, remember I'm using the full account to buy the maximum amount of share in each instrument. And I have a function for that, and it's available in the code. I buy up to maximum of 5,000 shares. To get more Larry Connor strategies, watch this video, and I will see you there.